Wow, this is just crazy. Look at the headlines recently. Seriously, we absolutely have to dive right into this today. Robinhood is rolling out an artificial intelligence agent that literally trades your hard-earned money for you, like a robot with its hands on the steering wheel of your portfolio. And on top of that, at the exact same time, they are aggressively expanding into the UK, Canada, and rolling out their very own Layer 2 blockchain. It honestly feels like they're trying to become some sort of massive global sci-fi financial empire overnight. I'm your host, and welcome to today's Explainer. To uncover the absolute truth behind this massive global expansion and this wild AI rollout, I brought in our chief investment analyst. Analyst, the stock price has been fluctuating wildly in the pre-market. The headlines are absolutely everywhere. What on earth is actually happening over at Robinhood right now?
Well, let me break this down for you. If you look at the corporate communications coming out of their recent keynote event at the Old Royal Naval College in London, you will clearly see that this isn't just a sudden, reckless move for the sake of media attention, not at all. It is a highly calculated, fundamental structural shift. The numbers, and more importantly, the underlying technology, reveal a very specific long-term strategy. Today, we are going to completely strip away the media hype. We are going to look purely at the hard, cold data behind Robinhood's wild new frontier to understand exactly what is driving their valuation right now.
We will follow a strict four-step blueprint today. First, intro and the big issue. Second, a financial deep dive. Third, industry environment and economic moat. And fourth, survival scenarios. I will not give you speculative opinions here. We are strictly looking at the mathematical probabilities based entirely on their SEC filings and official announcements.
Okay, part one, intro and the big issue. Let's get right into it.
We've all seen Robinhood stock, ticker symbol HOOD, making massive, unpredictable waves. I mean, 1 minute it's jumping to a near 6-month high on the news of European derivatives, and literally the next minute it's dipping pre-market after breaking some AI Guinness World Record. The volatility is giving retail investors absolute whiplash. I demand to know what is actually going on behind the scenes here. Are they just throwing spaghetti at the wall to see what sticks, or is there an actual master plan? Break down these 3 real causes for me.
The volatility you are seeing is a direct, data-driven reaction to 3 massive, simultaneous product rollouts that completely alter their traditional business model. The market right now is simply trying to price in the massive execution risk of transforming from a simple US-based stockbroker into a decentralized, AI-driven global financial hub. If you look at the data here, cause number 1 is their aggressive global expansion. They just made crypto trading available in the UK. They completed the acquisition of WonderFi to officially open up to Canadian residents, offering 0 trading fees until September 30th. And they expanded perpetual futures products to 30 different European countries. Cause number 2 is the launch of the Robinhood chain. They officially launched a public mainnet Layer 2 blockchain built on Arbitrum, integrating directly with Uniswap to offer out-of-the-box decentralized finance, or DeFi. And finally, cause number 3, which is by far the most disruptive, is the introduction of AI agentic trading. They have officially opened up market access for AI agents through their MCP servers, which essentially allows a third-party AI to completely automate a user's investment decisions.
Wait a minute, doctor, that's way too complicated. That is a lot of complex terminology all at once. Before we get deep into Layer 2 blockchains and AI MCP servers, let's take a step back for a second. What does Robinhood actually do at its core? Could you give a simple analogy that even an elementary schooler could understand? Because some of our viewers might only know them from that whole GameStop saga a few years ago.
Of course. Let me break this down for you with a very simple analogy. Historically, the stock market was basically like a restricted private highway where traditional brokers set up physical toll booths. They charged high fees just to let you enter the road. What Robinhood did was build a digital toll booth, but they completely removed the toll fee. They democratized finance by letting anyone, regardless of their wealth or their background, drive right onto the global financial highway for free, straight from their smartphone. It's proven by the numbers. They were the first U.S. retail broker to offer zero-commission stock trading with no account minimums, and that single move forced the entire financial industry to change their fee structures. Now what we are seeing today is them trying to build those exact same toll-free highways across the entire globe and seamlessly into the highly complex crypto world.
Stage 2, financial and fundamental deep dive.
So, what you just said basically means Robinhood is trying to take their famous free highway model and aggressively expand it across the whole world using crypto and AI. Okay, I get that. But this is where I have to play devil's advocate. Expanding globally,
Building out entirely new blockchains and running massive AI servers is incredibly expensive. Are they actually making any real money from all this wild expansion? Or are they just burning a mountain of cash to generate media hype? Over $1 billion in a single quarter? Come on.
The top-line numbers absolutely prove it. They are making real money. If you look at the Q1 2026 earnings report here, total net revenues increased by 15% year over year, jumping from $927 million in Q1 2025 up to $1.07 billion in Q1 2026. Furthermore, their net income attributable to Robinhood actually increased to $350 million. They are absolutely not running a deficit. In fact, their net margin currently sits at a very healthy 32%. So, it is true that their operating expenses did increase by 18% to $656 million, and that was largely driven by the technology, development, and general administrative costs related to these massive global rollouts, but their core revenue engine is actively and steadily outpacing the massive costs of this aggressive expansion.
RMG? Really? $307.3 billion? What exactly is this massive number representing? Is this how much Robinhood, the company itself, is actually worth? No, this is not their market capitalization. This number is their total platform assets, which is also known in the industry as assets under custody. This is the total combined value of all the cash, stocks, and crypto that retail users are currently holding on the Robinhood platform. And it increased by a staggering 39% year over year to hit that $307.3 billion mark. The SEC filings show that this massive growth was driven by the continued net deposits, which came in at $17.7 billion just for this quarter alone, as well as generally higher equity valuations and acquired assets from integrating platforms like TradePMR and Bitstamp. Furthermore, their funded customers, meaning people who actually put money into their accounts, increased by 6% to reach 27.4 million users. This data validates a crucial point. Despite all the media noise and stock volatility, overall user trust and retail capital allocation on the platform are expanding, not shrinking.
So what you just said basically means Robinhood is completely flush with cash. They are making over $1 billion in revenue, and they are successfully holding over $300 billion in user assets. But here is my contrarian question for you. If they are making such good money, why is the stock price experiencing such dramatic dips? And why is the market going so wild reacting to their crypto announcements? What is the catch here? Because Wall Street doesn't just panic and sell off for absolutely no reason.
You are exactly right to ask that, and the catch lies deep within the composition of their transaction-based revenues. While the overall top-line revenue is growing steadily, the underlying individual segments are showing extreme divergence. The market is reacting wildly right now because Robinhood's revenue engine is still highly exposed to the unpredictable, cyclical nature of the retail cryptocurrency market. Let's break down the specific individual revenue streams so we can logically understand exactly where this vulnerability lies.
Ah, wow, look at that massive crypto drop on the table.
Exactly. If you look at the data here, you can see the divergence clearly. Equities revenue surged by a very strong 46% to $82 million. Options revenue grew steadily by 8% to $260 million. But look at the crypto segment right below it. It plummeted by 47%, dropping all the way down to $134 million. Transaction-based revenues rely entirely on retail user trading volume. When the crypto market cools down and enters a cyclical winter, casual retail traders simply stop transacting. When they stop trading, Robinhood's payment for order flow revenue in that specific segment completely collapses. This exact 47% drop is the mathematical catalyst for why Robinhood is so aggressively rolling out the Robinhood chain right now and pushing so hard into the UK and Canada. They are desperately trying to reignite their crypto growth engine by opening up brand new, untapped international markets and new DeFi services to offset this severe domestic stagnation.
So the core issue here is just raw volatility. 1 month crypto is super hot, everybody is buying, and the next month it's completely dead, and Robinhood's revenue just swings wildly right along with it.
That is absolutely correct. It's proven by the numbers. The month-over-month change metrics released in their official performance reports reflect this extreme cyclicality perfectly. Daily average trades and average daily volumes for crypto can, and often do, swing by double digits within a single 30-day window. However, it's absolutely vital to note that Robinhood is actively stabilizing this wild volatility through their net interest revenues, which actually increased 24% year over year to $359 million. This revenue comes from margin lending and the interest they earn on corporate and customer cash balances. They currently boast a $19.5 billion margin book and $28.8 billion in cash sweeps. So logically, while their transaction revenue is highly volatile, these interest-earning assets provide a massive, stable financial cushion. It is this exact cushion that prevents the company from bleeding out financially during these harsh crypto winters.
Stage 3. Industry environment and economic moat. So, what you just said basically means that while their crypto trading fees are dropping really fast, their traditional, boring stack trading and the massive interest they make off holding cash is keeping the whole ship highly profitable. That makes perfect sense. But if traditional finance is what's keeping them afloat, why on earth are they spending all this energy and money building out complex blockchains and AI? What is Robinhood's unique, irreplaceable weapon, their economic moat moving forward? Let's dive into this Robinhood chain. What makes it so special compared to everything else out there?
To truly understand their economic moat, we have to look at the global macro trend occurring in the market right now. The gap between traditional finance, or TradFi, and decentralized finance, or DeFi, is rapidly closing. Robinhood's moat is their unique ability to act as the ultimate user-friendly bridge between these two highly complex worlds. According to their official launch documents, the Robinhood chain is a Layer 2 blockchain built to strict institutional standards using the Arbitrum platform. It features deep, native integrations from massive industry leaders like Alchemy, BitGo, and Chainlink. What this actually means in practice is that they are offering out-of-the-box DeFi primitives directly to casual, everyday users who wouldn't normally know how to navigate a blockchain. For example, they launched a feature called Robinhood Earn, where users can seamlessly lend out USDC on-chain via a self-custody wallet and earn an estimated 7% API. Furthermore, they rolled out stock tokens in over 120 countries, allowing 24/5 trading of US-listed stocks without the massive foreign exchange fees that are normally associated with international stock trading.
Wait a minute, doctor. Hold on. The 7% APY and the global stock tokens sound great and all, but I want to talk about the real elephant in the room here. What exactly is an AI trading agent, and what does it actually have to do with our everyday stock accounts? Are people really just letting robots play with their life savings?
That is exactly what they are doing, and automating that process is the absolute core objective of this new product line. Let me break this down for you logically. Robinhood clearly recognizes that the technical complexity of DeFi, things like managing private seed phrases, paying gas fees, and conducting real-time on-chain market analysis, is simply too high for the average retail investor to handle. Therefore, the basic role of the AI agent is to completely abstract and automate these complex strategies. Through Robinhood's new MCP server architecture, a user can securely connect a third-party AI agent directly to a dedicated Robinhood agentic account. By doing this, the user is effectively handing over the steering wheel of their portfolio directly to the algorithm.
Okay, but how is this fundamentally any different from just setting a basic limit order on a stock or using one of those standard robo-advisors that have been around for years?
It is fundamentally and structurally different. Traditional investing, even with robo-advisors, ultimately requires your direct human input or pre-approval on the overarching strategy and every single transaction type. You read the news, you analyze the chart, you click buy, you click sell. A limit order just automates the timing of a manual decision you already made. Agentic trading, however, allows the connected AI to independently explore novel trade ideas, dynamically build and rebalance entire portfolios on the fly, program its own custom tools, and execute high-frequency trades rapidly as its internal strategy dynamically evolves based on real-time data, all without your direct input or pre-approval. The core objective here is providing seamless, incredibly low-latency market access for advanced large language models to actively trade on behalf of the user in real time.
Oh my God. Really? That sounds incredibly dangerous. What if the AI just completely hallucinates and decides to buy a bunch of terrible meme coins right before a massive market crash? That is precisely the fatal weakness of this entire system, and Robinhood is explicitly clear about this in their legal disclosures. The underlying risks are incredibly severe. They state that agentic trading involves significant risk, up to and including the possible loss of your entire investment. The AI can absolutely make mathematical errors, it can misinterpret market instructions, it can act on incomplete or outdated news information, and it can behave in entirely unexpected ways. Because the AI acts so rapidly, processing trades in milliseconds, it can be nearly impossible for a human being to monitor it or stop it in real time before the capital is already deployed and potentially lost. And, most importantly, Robinhood legally and explicitly states they are absolutely not responsible for any losses resulting from agent-generated decisions. You, as the user, assume 100% of the financial risk for any trades executed by these third-party AI providers. Stage 4. 3 survival scenarios. Let's forecast the future.
So what you just said basically means you can let an AI run your entire portfolio, but if the robot hallucinates and completely drains your account to zero, Robinhood washes their hands of it completely. That is a massive regulatory and financial risk. Based on these wild technology leaps, the dropping crypto revenues, and the massive traditional cash buffer you mentioned, I challenge you to give us 3 concrete survival scenarios for Robinhood.
Where is the stock actually going? Let's start with the optimistic bull case. What exactly needs to happen for Robinhood to shoot to the moon?
If you look at the data, the feasibility of the bull case is actually quite high, but it is strictly contingent on their new technology holding up under global market stress. The specific triggers for this optimistic scenario include the successful user acquisition in the UK and Canada, which mathematically must scale fast enough to fully offset that 47% drop in US crypto revenue. Secondly, the Robinhood chain's 7% AP lending pool must prove mathematically reliable over time and attract massive global liquidity away from competing DeFi sectors. Finally, and most crucially, the third-party AI agents must conclusively demonstrate that they can consistently outperform standard market averages without experiencing catastrophic, portfolio-draining glitches. If these three exact triggers hit, Robinhood successfully transitions from a simple US discount broker into a dominant global AI and DeFi ecosystem, which would drive massive valuation multiples for the stock.
And what about the pessimistic bear case? What is the absolute worst-case nightmare situation here? The feasibility of the bear case is moderate, primarily driven by severe international regulatory headwinds. The triggers for this pessimistic scenario materialize if a connected third-party AI agent severely malfunctions on a large scale, causing a highly publicized rapid loss of retail capital. Even with their bulletproof legal disclosures in place, a massive loss event like that would invite immediate SEC crackdowns and completely crush retail trust in the platform. Additionally, if financial regulators in the EU step in to strictly restrict or ban the trading of their synthetic stock tokens, and the underlying global crypto market enters a prolonged multi-year bear cycle, Robinhood's core transaction revenue will face severe, unstoppable contraction, leading to heavy, sustained stock sell-offs. So, taking all the hype and fear out of it, what is the most likely outcome? Give us the base case, based purely on the hard numbers we have today. Based strictly on the Q1 metrics we reviewed, the base case is by far the most mathematically probable future. The trigger here is simply a steady continuation of their current financial performance. Traditional equities, which grew by 46%, and options, which grew by 8%, alongside their massive $359 million in stable net interest revenue, will continue to act as an impenetrable financial fortress for the company. This highly profitable, traditional brokerage operation will easily generate enough cash flow to subsidize the extreme volatility and massive capital burn of their global crypto and AI experiments. Meanwhile, their international user acquisition will continue to grow at a steady, if not explosive, pace. The stock will absolutely experience volatility, but the underlying cash flow will mathematically prevent any catastrophic corporate collapse while the new AI and blockchain tech slowly matures and finds its true product-market fit. So, the crucial takeaway point here is that underneath all the wild sci-fi AI hype and the scary crypto volatility, Robinhood is actually running a very boring, highly profitable traditional cash and stock business that is happily paying for all these futuristic experiments. That actually makes a lot of sense when you put it like that. And it perfectly brings to mind this truly famous quote from Warren Buffett: "The stock market is a device for transferring money from the impatient to the patient." If you are investing in Robinhood right now, you absolutely need the patience to weather the storm as they figure out this extremely complex integration of AI, DeFi, and global regulations. Analyst, thank you so much for stripping away the hype and walking us logically through the hard data today. It is truly fascinating to see how the mathematical mechanics of a company actually operate behind all the flashy news headlines. And to everyone at home, thank you so much for watching today's explainer. Your subscriptions, likes, and supportive comments are a huge, huge encouragement for our explainer series. Drop a comment below right now. If a rogue AI drains your portfolio in 3 seconds while you are fast asleep, who is really to blame? Would you ever willingly hand over the keys to your hard-earned money to a robot? Let us know your thoughts, and we will see you in the next deep dive.